Hello everyone, welcome to the ninth episode of Portfolio Update. How are you guys doing? Are you happy and safe? Are you investing consistently and taking the advantage of market going up? I hope so. This is a very special episode for all of us here. First of all, we achieved 3000 subscribers. Woohoo! And then the market is catching up the new heights and portfolio is going towards the right direction. And that is up and up. I don't know when you joined me in this journey, but when I started this channel, the market was crashing and my portfolio was 50% down at 7 lakhs. Everything was dark and gloomy around us because of pandemic and lockdown, and the future was looking very bleak. But now things have settled to be little normal. Even though recently there have been some spike in COVID cases, but still vaccines and time has taught us and made us aware of safety and how to deal with it. Market is also doing great and companies have started to look towards recovery path. So this seems like a wonderful time to thank all of you for being a part of this building 1 crore rupees portfolio journey. Pause the video and tell me in the comments below at what point you joined us in this journey. Like, where was the portfolio at that time? 7 lakhs, 9 lakhs, 15 lakhs? Write down below and let me know. So what do we have in today's episode here? First, we will start by going back to the first video from where I started this channel, and then we will quickly go through the journey portfolio has made it till now. We will do a fun game where we will see the price of shares at that time and see how much money you would have made if only you continued buying with me from then. Then we will be discussing the stock that is in my watch list from long time, and I might get into it once I get convinced about the price. After that, we have update on my dividend income. I just received some more money, so it's adding to the previous pile. And we will see how richer, wealthier and billionaire it made me. And in the end, we are going to understand the most important thing in value investing, and that is what is intrinsic value and how to calculate it to figure out the future multi-bagger. So let's start. So when I started this channel, I had 9 shares in my portfolio and the whole thing was down 47.91%. It was just Asian Granito that was 10% up and holding my self-respect with threads there. And I even joked in that video that whether it was a good idea to start the channel with portfolio this down. So it was all funny back then to make the video. Though in my mind I was very clear that this will pass and I had trust in the stocks that I had. Remember, back then out of 9 stocks, 4 were 50% down, 2 were more than 60% down, and they were going down from there also. It was all like a snowball. My portfolio was falling, my business was shut, employees needed to be paid. Overall, it was terrible and the pandemic made the future look like that the world is coming to an end. Well, when your invested money starts going in red, you anyways feel like everything is coming to an end. But I kept saying at that time also that I will keep on buying into these companies whenever I will squeeze money from elsewhere, and that you guys should also go ahead and keep investing. So I kept buying into all the falling shares in quantities I could afford to in bad times like that, and kept you guys updated about it. Let's have some fun and see the price change of those shares from then to now and see how much money you could have made on my advice. Rain Industries was at 55 rupees and now it is 132 rupees. Asian Granito was at 186, now 298. Butterfly Gandhimati was 103, now 421. LT Foods was 16, now 56. Repco Home Finance was 152 rupees, now 263 rupees. Viatech Vabag was 101, now 203. Edelweiss was 41, now 82. Everest Industries was 149, now 288. GVK was 2.45, now 3 rupees. So had you invested the money at that time, you could have easily more than doubled your money in just 8 months. Couple of people actually did that and I was very surprised when I got the message about that. 4 of the subscribers actually bought Butterfly after I said I'm going to keep buying at that price, and they made almost 4 times their money. It's pretty incredible what can happen. Though remember, this all calculation is just for fun. I never recommend that you guys copy me in this journey as I'm no expert and my knowledge is very selective. Okay, let's quickly see the journey portfolio has made it till far from starting, because we have a lot of new subscribers who were not the part of this beautiful journey back then. Okay, let's move ahead and see what changed in my portfolio since last update. It is currently worth 18,75,018 rupees and is up 33.34%. As it is going on from last few updates, Butterfly Gandhimati is on pretty good run. It is up 193% right now. It is still far away from its shining peak of 600 rupees, and when it will reach there, my profit will go up to 330% and it will become the biggest pie of my portfolio. So waiting for that and more to happen. Then LT Foods is 110% up, Asian Granito 68%, Everest 69%, and Rain Industries 16% up. Suntech Reality is also up 81%, but I don't know how to feel about Suntech going up. I wanted to buy more of it, but it just shot up crazy. I love the price at which I have it currently, but I wanted to buy almost worth 2 lakhs of it, but couldn't do. Now the Mumbai real estate has picked up the pace because of some new tax rules from government, and that is making sales go up, at least for a while. So I think for time being at least, Suntech is not going to go down. Even if it goes down in the future, it won't be coming to my current buying price, and hence I will buy eventually at higher price. And I'm rubbing my hands like evil villain in anticipation from cartoon movies, waiting to pounce on this share once again. I bought more of Edelweiss shares as I said I will do in last video. I bought 76 shares at 53 rupees, then 79 shares at 51 rupees. My plan was to keep buying every day or every other day in small quantity as long as it stays below 55 rupees price. But after initial buying, it just shot up and I stopped buying. I will be buying again if it falls down below 55 rupees, but I'm not fixated on the price right now. I can be buying it maybe at the current price also. I will see on that. And at this time, I think I'll be putting good 20 to 40,000 rupees in it straight. Anyways, my average is down to 78 rupees from 96, so that's good. Another change that happened in portfolio was that I sold all my GVK shares. As I have mentioned in earlier episodes, I bought GVK mainly for their airport business, but after they sold it, it did not make much sense for me to stay in the company, so I'm out. Many a times I get asked about when to sell the stocks, and I have a very simple answer to that, with a practical viewpoint on it from this case. Whenever you think the story for which you bought the company is no more there, sell it. Doesn't matter if it's in red or green, get out of there and invest in something that makes sense. That is the right way to make money in long term, and also as a great rule of thumb. And don't be afraid to fail. You're gonna fail many times in this journey. Out of 10 stock portfolio, 2 or 3 stocks are going to disappoint you and you will lose money there. But because other stocks will do so well that your actual invested amount will never go down. And remember, after you sell, the stock can also shoot up and become multi-bagger, and that's totally alright. As long as you stick to your own ideas and you keep learning, you will eventually end up making good money. So the overall performance of portfolio from last update video is 3,63,176 rupees up. That is 24% up from last video I posted. That's pretty good. Remember, it's all about learning. Learning from mistakes, learning from books, actions, interviews. And as there are so many companies and so many stocks to cover, the best way to push yourself initially towards learning more about a particular stock you are interested in buying is by purchasing a small amount of their shares. Yes, this is what even Warren Buffett does. Whenever he is interested in buying shares of a company, he buys 100 shares of it and keep learning about its business. What that does is that when your money is invested somewhere, then you get more involved into that stock and your interest kind of peaks there, and you will be more willing to keep learning and trying to understand the business better. It works for most of my friends too, and many big investors. Might also work for you guys, so try out, buy just 1 or 10 shares and keep that in watchlist. So the company that is in my watchlist from some time is NoSil. It is a leading manufacturer and seller of rubber and tire chemicals in India. They have factories in Maharashtra, Gujarat. They have very less debt in their balance sheet. Sales growth and profit growth is around 10% and above. Maybe it changed a little recently because of pandemic, but we are always looking for long-term play, so short-term fluctuations doesn't matter. One down point that I can see here is that promoters own only around 34%, and that too is heavily pledged. I think around 9% of that is pledged. This company has been in my watch list from quite some time, and it went down to a very low level in March-April time, and I almost bought into it. But then I found other better opportunities and I skipped it. But in future maybe it will happen. I might put some big cash there. That brings us to my cash management. So as it was looking earlier that my business will be on its feet soon, but it has gotten worse. Feeling a lot of heat and things are not in my favor. I'm still making just 40% of what I was making pre-pandemic, and before I cry more about it here, let's just move on. Cash remaining in hand, 11% of total net worth. Let's see what's the update on my dividend income. As I have mentioned earlier, my investing process doesn't rely much on whether the company pays dividend or no, but it can be a good factor in some scenarios, and it's fun to calculate when you receive extra money from somewhere. So let's see. Okay, so Rain Industries gave 8,942 rupees, Butterfly 1,267.50, Asian Granito 1,244.20, LT Foods 3,546.25, Repco Home Finance 925 rupees, Suntech Reality 447, Everest Industries 120 rupees. So it brings the total to 16,491.95 rupees. Wow, that's pretty awesome. This is a pretty good number and my holdings are for long term. So in few years, these dividends hopefully will keep growing and might start paying for my rent also. Like for a month at least in a year. Hopefully the coming years are going to be good as we as nation still have not found our growth. At least what over a billion population and one of the youngest nation can really do in the world. So I'm really rooting for India's growth in future and along with it I will go up too. We as tiny My Money Universe community will go up too. Talking about up, guys, please press the thumbs up button, yeah? Let's see some 200-300 likes on the video, man. Never got them. But recently channel has seen some good growth and it's all thanks to the community we are building here of My Money Universe channel. You guys have been promoting us endlessly and hence we are able to grow forward. So thank you and press that thumbs up button. Now, the most important thing in value investing, that is intrinsic value. So what is intrinsic value of a company, of a stock? Basically it means what the asset is worth actually, irrespective of its current market price. There are many ways of finding an intrinsic value of a stock. Sometimes it's by DCF, discounted cash flow, sometimes by other qualitative factors like business model, governance, target market, etc. etc. Doesn't matter which way you calculate it. The main thing that an investor needs to understand is that the final outcome of his or her calculation is just an estimate. Intrinsic value is a range like between 35 to 55 rupees or something like that. It's never a definite number. Now once we know what it means, let's hear from the god of value investing himself how he made billions by his way of calculating intrinsic value of a company.
And this is a question about intrinsic value, and it's a question for both of you because you have written that perhaps you would come up with different answers. You write and speak a great deal about intrinsic value, and you indicate that you try to give shareholders the tools in the annual report so they can come to their own determination. What I'd like you to do is expand upon that a little bit. First of all, what do you believe to be the important tools, either in the Berkshire annual report or other annual reports that you review in determining intrinsic value? Secondly, what rules or principles or standards do you use in applying those tools? And lastly, how does that process, that is, the use of the tools, the application of the standards, relate to what you have previously described as the filters you use in determining your valuation of a company?
If we could see, in looking at any business, what its future cash inflows or outflows from the business to the owners or from the owners would be over the next, we'll call it 100 years, or until the business is extinct, and then could discount that back at the appropriate interest rate, which I'll get to in a second, that would give us a number for intrinsic value. In other words, it would be like looking at a bond that had a whole bunch of coupons on it that was due in 100 years, and if you could see what those coupons are, you can figure the value of that bond compared to government bonds if you want to stick an appropriate risk rate in. Or you can compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them. Businesses have coupons that are going to develop in the future too. The only problem is they aren't printed on the instrument, and it's up to the investor to try to estimate what those coupons are going to be over time. As we have said, in high-tech businesses or something like that, we don't have the faintest idea what the coupons are going to be. When we get into businesses where we think we can understand them reasonably well, we are trying to print the coupons out. We are trying to figure out what businesses are going to be worth in 10 or 20 years. When we bought See's Candy in 1972, we had to come to the judgment as to whether we could figure out the competitive forces that would operate the strengths and weaknesses of the company, and how that would look over a 10 or 20 or 30-year period. And if you attempt to assess intrinsic value, it all relates to cash flows. The only reason for putting cash into any kind of an investment now is because you expect to take cash out. Not by selling it to somebody else, because that's just a game of who beats who, but by, in a sense, by what the asset itself produces. That's true if you're buying a farm. It's true if you're buying a business. And the filters you described, there are a number of filters which say to us, we don't know what that business is going to be worth in 10 or 20 years, and we can't even make an educated guess. Obviously, we don't think we know to 3 decimal places or 2 decimal places or anything like that, precisely what's going to be produced. But we have a high degree of confidence that we're in the ballpark with certain kinds of businesses. The filters are designed to make sure we're in those kinds of businesses. We basically use long-term, risk-free, government bond type interest rates to think back in terms of what we should discount at. And you know, that's what the game of investment is all about. Investment is putting out money to get more money back later on from the asset, and not by selling it to somebody else, but by what the asset itself will produce. If you're an investor, you're looking at what the asset is going to do, in our case, businesses. If you're a speculator, you're primarily focusing on what the price of the object is going to do, independent of the business, and that's not our game. So we figure if we're right about the business, we're going to make a lot of money, and if we're wrong about the business, we don't have any hopes. We don't expect to make money. And in looking at Berkshire, we try to tell you as much as possible as we can about our business, of the key factors. Those are the things that Charlie and I, the things we put in our report about those businesses are the things that we look at ourselves. So if Charlie had nothing to do with Berkshire, but he looked at our report, he would probably, in my view, he would come to pretty much the same idea of intrinsic value that he would come to from being around it, for X number of years. The information should be there. We give you the information that if the positions were reversed, we would want to get from you. And in companies like Coca-Cola or Gillette or Disney or those kind of businesses, you will see the information in the reports. You have to have some understanding of what they're doing, but you have that in your everyday activities. You'll get that kind of knowledge. You won't get it, in terms of some high-tech company, but you'll get it with those kind of companies. And then you sit down and you try to print out the future.
Wow, he's pretty awesome, no? So these are the points you need to focus on while determining intrinsic value of the company. Number 1, focus on the future cash flows of the business that you are buying. Number 2, how much would it earn for you in the future, and then work out how much of those earnings is the cash flow worth for you today. Number 3, you don't have to get to exact number, but just get a ballpark number. Let's take an example for that to make it simple for you guys. Let's imagine a potato farm which is costing you 100 rupees to buy and generates revenue of 15 rupees per year. After all the expenses, the cash remains in hand is 10 rupees per year. This is your free cash flow. This money goes in the owner's pocket, your pocket. Now looking at the future outlook of potatoes, demand and price, you will realize that the growth in sales is going to be 10% every year. Now taking in consideration of all these factors, you can come to a ballpark number for the intrinsic value of a company. And then you need to figure out whether paying 100 rupees for the farm today is a good investment or no. Of course, I'm oversimplifying things here, but just wanted to give you guys some plain simple example. As Warren Buffett famously quoted, it is better to be approximately right than precisely wrong. And what you want to do is that focus on those businesses that are more stable, where you have better idea of the earnings that they will get in the future. Some businesses, they are just too hard to put an approximate value upon. Either way, it is key that you know the value of the stock before you buy it. Then holding it through bad times like this year becomes easy Hopefully you have stayed till now with me in this video and gained some knowledge. If you did, then please smash the thumbs up button to let me know. I will see you next time. My Money Universe.